Bob, I want to pick up on your point about what's driving some of the increase in yields and the volatility. Peter Shear of Academy Securities pointing the finger at Washington, writing, quote, "The recent moves in yields have almost nothing to do with the Fed and everything to do with fiscal policy. The 10-year Treasury almost pierced 5% because no one knows what D.C. is going to do, and what we can surmise is not good." Bob, how much does this change your feeling on a broader level, just about bonds as a haven asset, and pushes you toward other asset classes?
Well, I think a lot of the repricing of the increased supply in bonds has mostly happened. And when I look across assets, the biggest question I'm looking at is what other assets are out there are not reflecting the meaningful rise in term premiums that we've seen, the meaningful rise in bond yields. If you think about bonds, particularly on the long end, they've fallen about 50% from peak. And you look across assets, for instance, stocks that remain just off highs. So if I'm thinking about which assets are overvalued in this market, it sure isn't bonds. It's much more stocks, not bonds.